In this week's video, we'll examine the question, will a diversified growth portfolio of ETFs and/or mutual funds reduce risk in a bear market? And for regular and loyal viewers, at the end of the video, we'll touch on the 2015 market. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. We recently saw on a reputable website from a very reputable and well-intentioned source, a source that's probably helped thousands of people over the years. They covered this portfolio here, which involves 10 different investments with a 10% allocation to each. It was basically referred to as the quintessential equity portfolio mix. It was discussed that it had enormous diversification. It's the best method to invest in the stock markets around the globe for long-term growth. It's based on top-notch research and more than 45 years of market experience, and it gives you diversification relative to the S&P 500. The purpose here is not to say that this is inaccurate. The purpose is to put it in some context so investors can implement any strategy, including this one, properly, because if you don't implement them properly, the probability of success will plummet. So this is the hypothetical portfolio that we will review. If you were not that experienced in the markets, and we understand people do other things, they have other jobs and families and things like that. If I put this in front of you and said that it offered enormous diversification benefits and you had your investments spread out amongst these investments, so different styles, large cap blend, value, small cap blend, small cap value, real estate, foreign stocks, large and small, and emerging markets, the term diversification might imply, especially if I'm not that experienced in the world of finance and investing, that diversification will offer some type of risk management. It will lower my risk exposure and help me smooth out returns. And the thought process may be, and the expectation may be, that if I own 10 different investments, some of them will most likely be positive when some of them aren't performing well, and hence I get the benefits of diversification and lower risk. Whether those assumptions are right, wrong, or indifferent related to that portfolio, I might believe that they're true. So the question we're going to look at is this pie chart. How much real-world diversification does a mix of ETFs or mutual funds provide, similar to the one shown, in a crisis or bear market? The purpose is to help us understand expectations of what can and cannot happen. Why? If I understand what I have and what I have to do to properly implement in the future, the probability of proper implementation over a full market cycle, a bull market and a bear market, will increase. The same is true for our strategy. It must be properly implemented over a full market cycle, and the performance must be viewed over a full market cycle. The same is true here, but I can't hold my pie chart over a full market cycle if I don't understand the potential downside in a bear market, because if it surprises me, it may be very, very difficult to hold through the full cycle to receive the benefits of the diversification and investing. Therefore, if I have to hold through the full cycle, it makes sense to understand the worst case scenario. How ugly could it potentially get during a bear market or crisis owning a mix of mutual funds or ETFs similar to the one here? So what we're going to do, we looked at these investments and we went to Yahoo Finance, we pulled the data, tried to make it as accurate as we possibly can, and we compounded daily, just as if we held them based on this allocation. How did these assets in this mix perform during the last bear market? Did they provide diversification benefits, and/or did they reduce risk, and did my pie chart help me sleep better at night? If I felt I was diversified, I might have been surprised. Here, this makes an assumption. Again, we're looking at the worst case scenario, because if we understand the worst case scenario, when it comes time to ride it out and we understand it, the probability of riding it out will be higher if this is the strategy I'm using. We don't use a strategy like this, but it doesn't mean this strategy is wrong. There's a million different ways to approach the market. As an investor, your job is to find something that makes sense to you and something that you feel you can implement over a full market cycle. Some people can hold this during a full market cycle, some can't. So you have to find compatibility of philosophy. If we invested $1 million into this allocation when the market peaked on October 9th, 2007, and held it, because this is a buy and hold strategy, until the market bottomed in March of 2009, our $1 million would have dropped to $405,000 and change. In this instance, the diversified mix here actually did a little bit worse than if I held SPY as a buy and hold investor. The loss from point A to point B, using this hypothetical portfolio and approximating the returns with historical data from Yahoo Finance, the return was negative 59.17% for this pie chart over the same period. If I bought and held SPY, including dividends, and I compounded it on a daily basis, this is approximately what my return would have been. So in this instance, the correlation of this portfolio is extremely high relative to the S&P 500. The lines zig and zag together for the most part, and instead of beating the S&P 500, we underperformed during the bear market. A buy and hold position or stake in SPY during the financial crisis dropped approximately, using this as an estimate, 55.19%. $1 million buy and hold in SPY would have fallen to approximately $448,000. Therefore, if I'm going to successfully implement a buy and hold strategy to receive the benefits when the market bottoms here, because the benefits will start to accrue quickly, I have to hold through here. And typically what will happen, we're all human beings. At this point, you may say, this isn't working, and you might abort somewhere in here. And then when the portfolio starts to accrue benefits and gain back, you don't participate. So this absolutely, from a historical perspective, can add value. But just like our system, it has to be properly implemented over a full cycle, a bull and a bear. And proper implementation here, the difficulty is having the discipline to hold through the difficult periods so you can receive the benefits during the good times. The difficulty with our system has difficult implementation characteristics. Ours requires discipline as well. So there's no free lunch in the financial markets. This only works if you implement properly. Any system only works if implemented properly. A fair and legitimate rebuttal might be, Chris, this is a one-time event here. Probably not going to happen again. Not a very good example to see if the diversification worked. Fair question. However, if you Google false diversification and my last name, you should be able to find a link in the first few choices in Google to this article from December 29th, 2006. So using similar concepts, here is a diversified mix of mutual funds. In this case, how did this mix perform in the dot-com bust? The answer is not particularly well. This mix here lost approximately 42% from August 30th, 2000 until October 7th, 2002. Over the same period, the S&P 500 in this case did lose more. It lost 46%. And these numbers here are based on this mix with stocks, a balanced fund, the NASDAQ, international growth, emerging markets, and European stocks. You can see it here. Moral of the story, it's a good idea to water test your portfolio and say, am I comfortable with what I own? If not, you can make some changes before the next bear market arrives, or you have to ask yourself, is this type of buy and hold strategy the right strategy for me? There's no right or wrong answer there. It goes back to compatibility of philosophy. Shifting gears back to the present day market, this is ACWI, or the Global Stock ETF. It's about half U.S. stocks, half international stocks as of the close on Friday, June 5th. This is a weekly chart. Resistance, 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 bullish breakout. What once acted as resistance may now act as support. You may remember from a video a few weeks ago where we covered breakouts in foreign stocks. We said retests are quite common, and that when you get a big move in one direction, that you can get a give back and a retest. So this chart, are there some concerns? Sure there are here. We're seeing some weakness here. However, there's also a basis for patience. Potential support at the blue lines and potential support here. If this ETF breaks into this area here, especially on a closing basis, our concerns would increase. So we'll keep an open mind heading into next week, and the math and the model and the observable evidence will help us manage risk if we need to. Before we move to the present day chart of the S&P 500, remember, we can't have a bear market until we move over to lower highs and lower lows. Same thing with a correction. Eventually, we're going to make a lower high and a lower low. And we said in last week's video that meaningful lower lows would be if we were to break these levels here, 2067, 2064, and most importantly, 2039. And back on May 29th, we had those levels in a tweet. So the first question would be, did we close below any of those levels? No, we closed at 2092 and change on Friday, June 5th. Basic premise is not too many bad things can happen. We can't go into a 3-week correction, a 3-month correction, a 3-year bear market, or a 30-year bear market without closing below these levels first. That doesn't tell us whether or not we will do that. It's just a risk management technique. Why do we use it? Because nothing guarantees that we will close below these levels, and we might look back in 6 or 9 months and say, hey, momentum was slowing, being patient there paid off. So the primary trend is unequivocally still up and favors the bulls. Therefore, the market has to force us out of our positions by proving to us that something material has changed. That may or may not happen. It just hasn't happened yet. Also, notice here, support. This little cross here tells you this is the high of the day, this is the low of the day, the cross is the close. That's what's known as kind of a doji look. It's indecision. It says we closed right in the middle of the range near support, and sometimes that happens near a reversal. That could be true in a daily chart, a weekly chart, a 60-minute chart. Indecision, near support, we bounce. Indecision, near support, we bounce. Indecision, middle of the range where we close near support, we bounce. Indecision, middle of the range near support, we bounce. Friday, we held here, 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 and the main ones are here, here. We did hold here on Friday, and we do have that doji or indecisive look. Does that tell us that we're going to bounce on Monday? No, it doesn't tell us that. It just tells us that the probability of a bounce is higher than if we saw a close like this or a close below the dotted line. So we have several areas of possible support telling us to try to be patient with our long positions. We'll keep an open mind heading into next week. As I mentioned in last week's video, momentum is slowing. It is a concern. Therefore, if we break these levels, and especially 2039, the math is going to require us to move away at a much more rapid rate now than if it was breached here. Why? Momentum's not as slow here as it is here. Is the model and is the observable evidence starting to show some of that slowing momentum? Is it creeping into these charts? The answer is yes, but not significantly. Here, remember, we have 38 bad things that can happen when we move from a full-bore bullish look to a full-bore and higher risk bearish look. How many of them have happened? 6 of the 38 have happened. However, the 6 that have happened are the least significant from a probabilistic perspective, but it does tell us that we're seeing some deterioration. We're closer to this look today than we were last week. Not much closer, but we're closer. Remember, the market model uses numerous inputs. The moving averages that we show here every week, they're back-tested, they're useful, but there's nothing magical about them. Therefore, we diversify our inputs. This is a scary look here. The fastest moving average is on the bottom, and the slopes of all of the moving averages have rolled over, and the moving average has now made a lower high and a lower low. The exact same weekly moving averages as of the close on June 5th look much, much better, telling us that typically, if we're going to morph into a bear market look like this, it typically would take some time. Anything can happen. This just speaks to probabilities, telling us that bullish, aggregate bullish conviction relative to aggregate bearish conviction, when viewed from all market participants around the globe, is much more constructive and positive today than it was here, here, or here. This can morph into a look like this. We don't anticipate that. We need to see it. If you didn't see this tweet, it's worth noting. It's extremely important that we get a look of consolidation and sideways movement. Stocks go sideways here for a year. That we keep an open mind about bullish and bearish outcomes. It's very, very easy to visualize bearish outcomes here. Why? Because momentum is weak, breadth is probably weak here. There's a lot of yellow flags that are happening as you consolidate, are being waved by the market from numerous sources. So it's easy for a human being to extrapolate that into we're going to go down. We may go down. See 2011. We go sideways, and then we get to early July and early August, and we fall rapidly, which absolutely, positively could happen here in 2015. Price will help us with that. But this can also morph into something like this. The orange box is shown in blue here. This is indecisive behavior, slowing momentum, slowing breath, and eventually we break to the upside. Price will guide us next week if we're willing to wake up on Monday morning with a flexible, unbiased, and open mind. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.